Welcome to The Explainer. I'm your lead analyst here at Iron Financial, and our entire mission is to help you forge a significantly stronger portfolio and cut right through all the market weakness we're seeing right now. Today, we are putting a massive, absolutely heavyweight retail player through a grueling stress test. We're looking at BJ's Wholesale Club, specifically drilling into their Q1 2027 results. Look, in a market where every single dollar of consumer spending is being placed under a microscope, retail stocks are being tested like never before. You've got soaring interest rates practically strangling credit cards, you've got inflation relentlessly eroding any wage gains, and honestly, the macroeconomic headwinds out there are just vicious right now. So, we are going to meticulously inspect the foundation of BJ's business model. We're looking at their revenue, their debt load, and their margins to see if they actually have the raw steel required to withstand these external forces. All right, let's dive right into this.
And I am your market skeptic, and I'm here representing you, the highly focused viewer. Because while our lead analyst over there absolutely loves to look at the shiny, top-line revenue numbers, my job is to get down into the blueprints and ask the hard question, is this hype or is it real? Listen, when a company reports earnings in an economic environment that is this volatile, we have to demand absolute clarity. We need to know for sure if the numbers they're building their entire narrative on represent a rock-solid foundation, or if we are actually looking at a massive structural hazard. And let me be clear, a structural hazard in the retail sector isn't just one bad quarter. It's when inventory starts to pile up in the warehouses, when strategic price cuts completely fail to drive any foot traffic, and when you wake up and realize the core customer base has fundamentally abandoned the brand. That is a total collapse, and it takes years to rebuild from that. We need to figure out if that's what's secretly happening here, underneath the surface.
And let me tell you exactly why my alarm bells are ringing right out of the gate. Literally right after these latest earnings dropped, BJ's stock took a sudden, violently sharp 8.6% plunge. Let that sink in. When a company with a multi-billion-dollar valuation sheds nearly 9% of its entire market capitalization in a matter of hours, that isn't just a slight correction. That is violent. We are talking about billions of dollars of wealth instantly vaporized as institutional computer algos and panic sellers essentially ran for the exact same exit doors simultaneously. So the central mystery that we absolutely have to solve today is this. Why did Wall Street completely bail on this stock despite the company actually posting a massive revenue beat? If the business is supposedly so structurally strong, why did the smart money aggressively smash the sell button? We are going to drill down into these financials and find out exactly what spooked the market so badly.
Well, that is exactly what we are here to do. Let's lay the core numbers down on the table for this debate, because this chart brilliantly illustrates the exact tension we're seeing. On the top line, revenue came in at an absolutely staggering $5.66 billion. That is a 9.9% year-over-year growth. Adding nearly 10% to your top line when the broader consumer economy is supposedly slowing down to a crawl, that is historically rare. I mean, in this current macroeconomic climate, most traditional retailers are fighting tooth and nail just to stay flat. Yet, despite moving massive volume and pulling in billions, look closely at the bottom line. Earnings per share dropped to $1.10. That's down from $1.13 a year ago. This divergence right here, selling substantially more volume but actually making less tangible profit per share, is the exact textbook scenario that keeps portfolio managers awake at night. We have a massive top-line expansion, but the bottom line is bleeding out. This is precisely why we need to tear this earnings report completely down to the studs.
Section 1. Inspecting the Revenue Foundation.
All right, to understand the integrity of the whole structure, we have to start with the true load-bearing beams of the company's revenue growth. Before we can start panicking about the shrinking margins, we have to verify if the actual core business of getting customers in the door and selling them goods is structurally sound. And honestly, the sheer consistency here is staggering. BJ's has now successfully delivered 17 consecutive quarters of traffic growth. Think about the gravity of that for a second. Through global pandemics, unprecedented supply chain crises, and soaring inflation, more people simply keep walking through their doors quarter after quarter. But here's the real kicker. It's not just the sheer foot traffic. This first quarter was primarily driven by larger ticket sizes. Consumers aren't just popping in for a quick gallon of milk and a loaf of bread. They are loading up their massive carts with big box staples, electronics, and higher margin discretionary items. That tells us that the physical expansion and the core value proposition of these clubs are bearing serious weight, fundamentally anchoring household budgets directly to BJ's.
Let's break down their growth blueprint a bit further. Comparable club sales were up an impressive 6.3%. And look, even when you strictly strip out the highly volatile price of gasoline at the pumps to find the true underlying retail baseline, their ex-Gascom sales were still up 1.5%. But for me, the real standout metric on this blueprint is their expansion into Texas. Now, you might be wondering, why is Texas so absolutely crucial? Because it is literally the battleground for wholesale retail right now. It's flooded with massive population influxes, an incredibly robust local economy, and zero state income tax, which means these consumers actually have more discretionary cash to deploy. To march into that hyper-competitive arena and completely outpace your own internal membership targets by a staggering 33%, that means they aren't just casually meeting their blueprint. They are actively playing offense. They are aggressively stealing market share from deeply entrenched competitors in some of the absolute most lucrative zip codes in the entire country.
And here's where we really unpack the structural integrity of their recurring revenue. BJ's currently boasts over 8 million members, but here is the true metric of hidden strength. 42% of those are higher-tier members. Why does this matter so much? Because higher-tier members deliver significantly greater lifetime value to the brand. They shop way more frequently, and they lock in a massive, undeniably impressive 90% tenured renewal rate. Look, here's a little trader-style reality check about how the warehouse model actually works. Companies like BJ's and even their massive rivals don't actually make the bulk of their net profits from marking up that giant 2-gallon jar of mayonnaise or that 65-inch flat-screen TV. They purposefully sell that physical inventory at razor-thin margins just to get you inside the building. The true profit engine, the raw, undeniable steal of the business, comes directly from collecting those annual membership fees. When you have a 90% renewal rate that is heavily skewed toward your highest-paying members, you have a guaranteed, ironclad cash pipeline that flows straight to the bottom line before a single product is even scanned at the register.
Section 2. Margins. Cracks in the armor.
Okay. The top line looks solid. I will absolutely give you that. But I am taking control of the analysis right now, because we need to aggressively pivot and examine the bending support beams of margin pressure and these heavy inflationary weights. We need to talk about the cracks in the armor. Listen to me. You did not lose nearly 9% of your entire market cap in a single day just because you successfully sold a lot of memberships down in Texas. Wall Street is clearly seeing stress fractures, and we need to locate exactly where they are hidden. When you contrast these core metrics, you have this beautiful 9.9% revenue beat shining on one side, but you have declining net income and a noticeable EPS drop dragging on the other. The merchandise gross margin rate, excluding things like gas and membership fees, actually slipped. And you have to understand, in the wholesale grocery business, your gross margin rate completely dictates your free cash flow. If that percentage shrinks even a fraction, the amount of actual usable cash you generate from every single dollar of sales compresses. So if you are selling way more goods, bringing in all this record traffic and opening highly successful new stores, but you are somehow making less actual money on the bottom line, your foundation might be settling. We have to ask, is the sheer cost of maintaining this growth simply becoming too heavy for the company to bear?
I hear you, but I have to firmly push back on that narrative, because this margin squeeze was absolutely not a structural flaw. It was a highly intentional strategic investment by the management team. Let me quickly explain what we're calling the tariff effect. Yes, BJ's took roughly a 50 basis point hit to their Q1 merchandise margins. In plain English, that equates to about a $20 million hit. But here's the context. They had tariff refunds coming in from the government. Now, instead of just hoarding that extra cash to temporarily pad their bottom line and make Wall Street analysts happy for one quarter, management proactively used those exact dollars to artificially lower prices for their members. They are playing a much longer game here. Deliberately sacrificing 50 basis points right now mathematically secures a much wider economic moat against their competitors down the line. They willingly took a short-term hit to earnings, specifically to build long-term loyalty and aggressively widen the price gap. When everyday consumers realize they are getting definitively, noticeably cheaper prices at BJ's compared to the standard grocery store right down the street, that consumer loyalty hardens like concrete. That is supreme financial discipline playing out in real time, not some dangerous crack in the armor.
Well, playing offense is great until the macroeconomic environment comes along and changes the rules of the game entirely. Let's literally bring up management's own words on this. CEO Bob Eddy explicitly warned investors on the call about the K-curve consumer. Now, for those unfamiliar, a K-shaped consumer base means the economic realities of their shoppers are diverging violently right now. The top arm of that K represents the affluent shoppers who are thriving, largely unbothered by high interest rates and still spending heavily. But the bottom arm of that K represents the lower-income shoppers who are severely buckling under the pressure, desperately cutting their discretionary spending just to afford basic necessities. Eddy noted considerable pressure on lower-income consumers, flat out pointing out that the only real growth right now is coming from the affluent side. If your core base is feeling this much squeeze from inflation, and we're looking at volatile macro pressures like $6 diesel eating into everyone's transportation and logistics cost, your so-called pricing power can easily break.
If the bottom arm of that K-curve completely fractures, that strategic margin investment you just praised suddenly looks like a very, very dangerous vulnerability.
And look, it is definitely not just me asking these tough questions. The biggest, most ruthless institutional players on Wall Street are completely torn on how to grade this exact stress test. Consider the massive institutional divergence we are seeing in the latest filing data. On one hand, you have Select Equity Group, which is a massively respected, fundamental-driven player, dumping a huge 2.69 million shares, completely abandoning their position in the stock. But on the exact same day, Citadel, one of the most quantitative, hyper-sophisticated market makers on the planet, steps in and buys up 1.66 million shares. Simultaneously, Amundi, a massive global asset manager, adds over 680,000 shares to their books. We literally have to ask ourselves, is the smart money abandoning a sinking ship because they see those gross margin cracks widening? Or are the financial heavyweights aggressively buying the dip on a structurally sound asset?
Section 3. Balance sheet heavy lifting. I will tell you exactly why Citadel and those other heavyweights are buying the dip. To prove this company has the raw steel necessary to weather literally any macroeconomic storm, you have to look at how they manage their debt and their capital. Forget the quarter-to-quarter noise of merchandise margins for a second. Let's look at the actual structural framing of the business itself. Since their IPO back in 2018, BJ's has executed a dramatic, frankly beautiful reduction in their net debt to adjusted EBITDA. They took it from a highly leveraged, risky 5.1 times all the way down to a fortress-like 0.4 times. Listen to me, moving a corporate balance sheet from a 5x leverage ratio down to under 1x is an absolute masterclass in financial engineering. Especially in an era of tightening credit, where the Federal Reserve has made borrowing exponentially more expensive, BJ's is incredibly insulated. When their competitors are drowning in exorbitant interest expenses just to keep the warehouse lights on, BJ's has a completely deleveraged foundation that gives them unparalleled strategic flexibility to operate and dominate.
And hey, if you don't want to just take my word for it, let's look at the independent third-party inspectors. Fitch recently initiated a first-time investment-grade rating for BJ's Wholesale Club. This right here? This is a definitive knockout blow to the bear thesis. Independent credit agencies do not just hand out investment-grade ratings to companies with structural hazards. It doesn't happen. Securing an investment-grade rating directly lowers a company's future cost of capital. It means when they do eventually need to borrow money to build more clubs, they get the absolute prime rates. It makes maintaining and expanding their physical foundation fundamentally cheaper than the competition. This upgrade publicly recognizes their profound financial discipline, their massive debt reduction, and their robust, highly reliable free cash flow. The foundation has been officially certified by the experts. End of story.
And because that balance sheet is so exceptionally strong right now, they aren't just patching up old holes. They are executing a heavy, aggressive, structural reinvestment strategy. They are proactively deploying $700 to $800 million in annual capital expenditure to aggressively build brand new clubs and update their digital infrastructure. And get this, they're generating high teens returns on investment on those new clubs. To put that into perspective for you, a standard retail benchmark return on new store capital often hovers in the high single digits or maybe the low teens if they are incredibly lucky. Generating high teens returns easily beats the broader S&P 500 average. Furthermore, having just fully utilized a $500 million share buyback program, they just forged a brand new $1 billion share repurchase program. They literally have the cold, hard cash on hand to expand aggressively while directly rewarding their shareholders at the exact same time.
Section 4. The final verdict.
All right, we have stress tested the revenue, we've hammered at the margins, and we've meticulously inspected the balance sheet. It is time to synthesize all this data and deliver our authoritative assessment on whether this stock can bear the weight of a volatile market. Let's rapidly summarize the core debate here. On the solid foundation side, you have unparalleled membership growth, an incredibly lucrative 90% renewal rate, a highly successful geographic expansion into the Texas battleground, and a balance sheet that is practically forged from titanium right now. But on the structural hazard side, you have deliberate margin compression that genuinely spook the broader market, shrinking earnings per share, and management's own open admission that their lower-income consumer base is deeply cautious and buckling under persistent inflation. It is a true heavyweight bout between internal operational strength and massive external macroeconomic pressure. But honestly, the ultimate sign of strength is how management themselves view the full structure going forward. Despite the Q1 earnings drop and the stock plunge, management fully reaffirmed their full-year guidance. They are confidently projecting ex-gas comp sales growth of 2 to 3% and an adjusted EPS of $4.40 to $4.60 for the year. Look, reaffirming guidance immediately after an earnings miss signals extreme internal confidence.
It is a massive psychological tell to the market that effectively says, we are not panicking and neither should you. It expresses total confidence that the heavy lifting and the strategic price investments they deliberately made in Q1 will result in a fully forged, highly profitable Q2 through Q4. They are actively prioritizing long-term market share over short-term margin padding, which is exactly how you build a lasting, dominant enterprise in this space.
So we are going to leave you with this final, provocative question to consider for your own strategy. You have seen the blueprints, you have seen the internal stress points, and you have weighed the raw, unfiltered data. The balance sheet is undoubtedly ironclad, but the macro environment is throwing absolutely everything it has at the consumer right now. Is BJ's Wholesale a durable, heavy-duty addition to your portfolio that will safely compound your wealth over time, or are the macroeconomic cracks simply too wide to ignore, making this a classic, dangerous value trap? Weigh the foundation against the hazards, do your own heavy lifting, and build your portfolio with iron discipline. Thanks for joining us on this explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.